In a dramatic turn of events, the once mighty Chinese property giant Evergrande faces a historic order for liquidation from a Hong Kong court. The company, drowning in over $300 billion of debt, has struggled for the past 2 years to find a viable plan to restructure its financial woes, despite its attempts to secure a 3-month extension. The court, led by Judge Linda Chan, firmly rejected the plea, stating that it lacked a substantial restructuring proposal. This landmark decision marks a significant moment in China's real estate crisis, with Evergrande embodying the challenges plaguing the sector. The company's unruly expansion, epitomized by its chairman Hui Ka-yan's extravagant lifestyle, has now come crashing down. The court appointed Alvarez and Marsal Asia as liquidators, tasked with minimizing disruptions for stakeholders and exploring restructuring strategies. The potential impact of Evergrande's unwinding is likened to the Lehman Brothers collapse during the 2008 financial crisis. The majority of Evergrande's assets, approximately 90%, are situated in mainland China, raising jurisdictional complexities. While a recent agreement between China's Supreme Court and Hong Kong's Department of Justice aims to recognize and enforce judgments, uncertainties linger about its applicability to Evergrande's case. The consequences of this ruling extend beyond Evergrande, as it sets a precedent for other troubled developers like Sunac China, Jiayuan, and Kaisa. Judge Chan, who presided over these cases, has demonstrated a firm stance, signaling challenges for defaulting developers. Investors worldwide had once hoped for a government bailout, but the liquidation order crushes those expectations. Evergrande's stock plummeted over 20% in Hong Kong, prompting a suspension of trading. The aftermath of this decision is expected to send shockwaves through China's financial markets, amplifying concerns during a stock market sell-off. The liquidators now face the daunting task of assessing Evergrande's financial position and formulating restructuring strategies. However, the Chinese government's reluctance to see property projects stall might pose challenges to the liquidation process. The fate of ordinary Chinese homebuyers who face delays in receiving their already paid-for apartments hangs in the balance. As the unwinding unfolds, questions persist about the enforcement of the Hong Kong court's decision in mainland China. Experts argue that adherence to mainland China's laws may hinder full control over Evergrande's operations. Foreign creditors may find themselves at a disadvantage compared to their mainland counterparts. The liquidation order not only marks the end of Evergrande's tumultuous journey, but also signals potential seismic shifts in China's property market and investor confidence. The ruling's repercussions will be closely watched, influencing the ongoing restructuring negotiations of other distressed developers entangled with offshore creditors. In the courtroom, the judge's declaration of "enough is enough" echoes louder than Evergrande's construction sites falling silent. The future of China's property sector, the fate of investors, and the handling of financial crises by the Chinese government now hang in the balance as the once mighty Evergrande faces its final reckoning. Evergrande's court-ordered liquidation will send shockwaves globally, triggering a sell-off in markets and raising concerns about China's economic stability. Investors faced uncertainties, financial institutions reevaluated risks, and governments scrambled to navigate potential fallout. The episode underscored the interconnected nature of the world economy, prompting a re-examination of global investment strategies and contingency plans. Evergrande's fate became a cautionary tale, leaving an enduring impact on the narrative of the interconnected financial landscape.